Usually, property and casualty insurance is basically the financial equivalent of watching paint dry.
Absolutely. It's so boring.
Right. I mean, it's actuary tables, regulatory filings, and, the kind of slow, defensive, sleep-at-night play that you just tuck away in the corner of your portfolio and completely forget about.
Yeah, you just let it sit there.
Exactly. But when a sleepy insurance company quietly increases its book value by 27% in a single 12-month period, you kind of have to stop and ask, is this a fluke?
Or is this the best kept secret in the market right now?
Right. So welcome to the Deep Dive. Today we are opening up the hood on the Q4 2025 earnings call for the Hanover Insurance Group.
The ticker is THG for those following along.
Yeah, THG. And if you are holding this stock or just looking for a place to deploy capital in a volatile market, you honestly don't have time to parse through 60 minutes of dense actuarial speak and Wall Street pleasantries.
Nobody has time for that.
Exactly. So we are going to translate the jargon, look at the headline beats, and really uncover the actual operational mechanics driving those numbers.
And figure out if management's new guidance is a massive green flag or if there are warning signs flashing under the hood.
Because it is a fascinating quarter to break down.
It really is. I mean, a 27% jump in book value fundamentally changes the narrative of what you expect from a company in this space.
Yeah, that is tech stock level growth hiding inside a 170-year-old insurance company.
Basically, yeah.
Yeah.
And as we dig into the data today, what you are going to see is really a masterclass in two things.
Okay, what are they?
First, capitalizing on favorable external conditions. And second, ruthlessly executing on internal operational discipline.
So let's get right into the data then. I want you to walk us through the headline numbers.
Sure.
Because reading through this earnings report, it just looks like a massive wall of green. I mean, management literally called this one of the best fourth quarters in their 30-year public history.
Yeah, they were not shy about it.
So what are the specific metrics that made Wall Street sit up and take notice here?
Well, the lineup of metrics is staggering, but four numbers really tell the core story of this quarter.
Okay, lay them out for me.
First, they hit a record full-year operating return on equity of 20%.
20%.
Yeah. Yeah. Second, their fourth quarter combined ratio came in at an incredibly lean 89%.
Okay, 89%.
Right, which brought the full-year combined ratio to 91.6%.
Got it.
Third, their net investment income surged almost 25% in the fourth quarter alone.
Just in Q4.
Just in Q4. It hit $454.4 million.
That is massive.
It is. And finally, as you teased in the intro, that all culminated in their book value per share skyrocketing 27% for the year.
Closing out 2025 at, I think, is $100.90 per share.
Exactly, 100.90.
Okay, so we need to translate a few of those for the listener because while an investor might know what a combined ratio is conceptually, the actual, actuarial impact of an 89% ratio is hard to fully grasp.
Yeah, unless you look at the industry baseline, it's just a number.
Exactly.
Oh.
So in a standard property and casualty environment, what is a typical combined ratio and why is 89% such a massive deal?
So to set the baseline, the combined ratio is essentially the holy grail of underwriting profitability.
Right.
It measures the money going out the door in claims and expenses versus the money coming in from premiums. So a ratio of 100% means the company is perfectly breaking even on its underwriting.
So they aren't making any money on the actual insurance policies at 100%.
Exactly, zero. And historically, many property and casualty insurers operate right around that 98% to 102% mark.
Wow, so they don't actually make a lot of money on the insurance itself.
No, they often just break even on the policies. They make their real money by investing the float.
The float, right.
Yeah, the cash they hold between collecting the premium from you and eventually paying out a claim.
Right, this is the classic Warren Buffett model.
Exactly.
You basically use the insurance operation to crowdsource a massive zero-cost loan from the public, and then you invest that loan to make your profit.
That is the exact model. But when you drop your combined ratio to 89%, you are no longer just breaking even on the underwriting.
Because you're keeping 11%.
Exactly. For every dollar you collect in premiums, you are only spending 89 cents to cover claims and run the business.
Leaving an 11% pure profit margin.
On the core business of just writing policies before you even touch the investment portfolio.
Wow. And when you have an 11% margin on billions of dollars in premium volume, I mean, the cash generation becomes immense.
Immense. And that leads right into the net investment income number we talked about.
Right. They brought in over $454 million in Q4.
Up nearly 25%.
So I assume that is the double engine effect happening.
Exactly what it is.
Look, they are generating a huge underwriting profit, which gives them more float. And then they are deploying that larger float into a favorable interest rate environment.
That is the compounding machine at work right there. Because over the last couple of years, we've seen a massive shift in fixed income yields.
Yeah, interest rates have been a wild ride.
They have. And insurance companies hold incredibly conservative portfolios, mostly high-grade corporate bonds, municipals, treasuries.
Safe stuff.
Very safe. But back in 2021 or 2022, they were buying bonds that yielded, 2% or 3%.
Right, when money was basically free.
Yeah. But as those old low-yield bonds mature and roll off the books today, Hanover is taking that cash plus the massive new cash generated by their 89% combined ratio.
And just plowing it into today's bond market.
Exactly, reinvesting it at significantly higher yields.
So their investment income is surging, not necessarily because they're taking on more risk, but simply because the macro interest rate environment is highly favorable for a cash-rich buyer.
Spot on. They just have more cash to invest at better rates.
Which brings us to the most impressive metric of all, in my opinion. That 20% operating return on equity.
It's a huge number.
I mean, for a mature financial institution, 20% is elite territory. It implies a level of capital efficiency that is very hard to sustain.
Very hard.
But wait, I have to play devil's advocate here.
Go for it.
Because this sounds a little like a golfer hitting a hole-in-one just because they had a 40-mile-per-hour tailwind.
Right, the luck factor.
Yeah. Insurance is inherently tied to things completely out of management's control, like the weather.
Oh, absolutely.
So did Hanover actually fix their swing, or did Mother Nature just decide not to throw any hurricanes at them in the fourth quarter?
Well, it is the single most important question you can ask when evaluating an insurance stock.
Right, because you can't rely on the weather.
Exactly. If a company beats earnings because the weather was quiet, you shouldn't assign a premium valuation to that company because the weather will eventually regress to the mean.
It always does.
Always. So to answer your question, they definitely had the wind at their back, but they also fundamentally overhauled their mechanics.
Okay.
We have to look at the weather first, though, because it was a massive factor.
Let's do it. Let's look at the actual catastrophe data. What
Wow.
did the weather modeling look like for 2025?
So in the insurance industry, they track what are called catastrophe losses, or CA losses.
ZAT.
Right. These are the large-scale, unpredictable events. Hurricanes, deep freezes, wildfires, and severe convective storms.
Basically the stuff that makes the evening news.
Exactly. For the full year of 2025, Hanover's CAT losses came in at just 4.5 points on their combined ratio.
That seems really low.
It is exceptionally low. The fourth quarter in particular was incredibly mild across their primary geographic footprint.
Okay.
And to his credit, Jeff Farber, their CFO, was very transparent about this on the call. He openly acknowledged that benign weather was a significant tailwind for their bottom line.
So they budgeted for a standard amount of natural disaster destruction, and the disaster simply didn't arrive.
And that unused budget just dropped straight to the bottom line.
I get that.
Yeah.
But as an investor, I can't build a thesis on the hope that it never storms again.
No, that's a terrible strategy.
So where is the evidence that they actually fixed the business operations?
The evidence is in their pricing power and their portfolio pruning.
Okay, break that down for me.
Let's tackle pricing first, because it is the ultimate indicator of an economic moat.
Right, the ability to raise prices without losing customers.
Exactly. Hanover didn't just passively collect premiums this year. They actively forced massive rate increases onto their customer base.
How massive?
In their personal lines segment, which is, the standard home and auto insurance you and I buy, they achieved a 9.2% rate increase on renewals in the quarter.
9.2% across the board.
On average, yeah. But homeowners insurance specifically saw a staggering 12.3% price increase.
Wow.
And auto was up 6.9%.
Okay, wait. I get the Apple ecosystem argument, right?
Right.
Once you have the iPhone, the Mac, and the watch, you don't switch to Android because the friction is just too high.
The lock-in effect, sure.
Yeah. But an iPhone is a luxury product. Insurance is a begrudged necessity.
That's a fair point.
Are you telling me that pushing a 12.3% price hike on homeowners didn't trigger massive churn? If my premium jumps 12% in a single year, my immediate reaction is to call a broker and get a quote from a competitor.
And you would think that would be the natural reaction for everyone.
Did they lose a ton of customers?
No. The CEO, Jack Roche, explicitly stated that retention levels remained incredibly stable.
How is that possible?
Well, there are two structural reasons why churn didn't spike. First, the entire property and casualty industry is dealing with the exact same inflationary pressures on home repairs and auto parts.
Oh, so everyone is raising rates.
Exactly. Almost every major carrier is pushing rate increases right now. So if you get mad at Hanover and leave to shop around, you're going to find that the competitors have also raised their prices.
There is literally no cheap safe haven to flee to.
Nowhere to hide.
Okay, that makes sense. It's an industry-wide repricing event. What's the second reason?
The second reason is highly specific to Hanover's strategic positioning. They don't go after the transient, price-sensitive shopper who buys, minimum limits auto insurance online.
Like the people chasing a slightly cheaper premium every 6 months.
Right. They don't want those customers. They target preferred accounts, specifically focusing on a highly bundled strategy.
Bundled, okay.
Yeah. They want the customer who bundles their high-value home, their 2 cars, and an umbrella liability policy altogether, often perfectly synced to a common effective renewal date.
This sounds like a paperwork nightmare to untangle.
And that is exactly the point. When a preferred customer has a deeply entrenched multi-policy ecosystem with one carrier, the administrative headache of unspooling that entire bundle and moving it to a new carrier just to save a few dollars a month, it's usually a strong enough deterrent to prevent churn.
It's the friction of paperwork overriding the anger of the price hike.
Completely.
Plus, if it's homeowners insurance, a lot of people have their premium paid directly out of their mortgage escrow account.
Oh, that's a huge factor.
Right, because they might not even notice a 12% hike on an annualized basis.
Yeah.
Because their monthly mortgage payment only goes up by a few dollars.
Precisely. They don't write a check for the premium, so they don't feel the sting. And because of that sticky customer base, Hanover achieved a critical inflection point that Wall Street just loves. Pricing finally outpaced loss trends.
Meaning the money coming in is growing faster than the cost of claims going out.
Exactly. The extra revenue they're bringing in from those double-digit rate hikes is now growing faster than the underlying inflation of fixing a bumper or replacing a roof.
Which creates structural margin expansion.
Exactly. It's beautiful to watch.
Okay, so they flex their pricing power.
Yeah.
But you also mentioned earlier that they pruned the portfolio. Where did they cut back?
They executed a highly targeted geographic retreat, specifically from the Midwest.
The Midwest, why there?
Since the beginning of 2023, they have intentionally reduced the share of Midwest business in their overall portfolio by roughly 4 percentage points.
But why the Midwest? Is it just the tornado risk?
It's tornado, sure, but more frequently, it's severe convective storms.
Convective storms, that sounds ominous.
It is the meteorological term for intense thunderstorms that produce straight-line winds and massive destructive hail.
Ah, hail.
Hail is an absolute nightmare for property insurers. I mean, a severe hailstorm can pass through a suburban neighborhood in 20 minutes and require thousands of complete roof replacements.
Just totally destroy the shingles.
Yeah, and at 20 grand a pop, that adds up instantly. The frequency and severity of these storms in the Midwest have made the region highly volatile.
So what did Hanover do?
They looked at their capital allocation, looked at the volatility of the Midwest, and simply decided the risk-adjusted returns weren't good enough.
So they just walked away?
They walked away from a significant chunk of that market.
Wow. It's addition by subtraction. You eliminate the volatility, and suddenly your earnings become much more predictable.
Exactly. But they didn't just change where they do business, they changed how they structure the policies, too.
Okay, let's talk about that.
Right.
Let's talk about the deductibles. Because when you dive into the mechanics of their homeowner policies, they made some massive changes that directly impact the bottom line.
They did, and this is really where the actuarial science shines. They actively transitioned a large portion of their book from flat dollar deductibles to percentage-based deductibles.
Specifically for wind and hail, right?
Yes, particularly for wind and hail perils.
Okay, I want you to walk us through the math on that. How does shifting from a flat $1,000 deductible to a 1% or 2% deductible change the game for the insurer?
It's a huge shift.
Because on the surface, it just sounds like a minor contractual tweak. Like, who really cares?
The actuaries care. It radically changes the claims frequency curve.
How so? Give me an example.
Okay, let's say you have a flat $1,000 deductible, and a storm blows off a section of your shingles, causing $3,000 in damage.
Right.
The insurance company is writing you a check for $2,000.
Because I pay the first 1,000, they pay the rest.
Exactly. But now, let's say you have a home insured for $500,000, and the insurer shifts you to a 1% wind and hail deductible.
Okay, 1% of 500,000. Your deductible is now $5,000.
Right. So in that exact same $3,000 storm damage scenario,
The homeowner absorbs the entire cost.
the insurance company pays absolutely nothing.
Wow. They just wipe out the claim completely.
Exactly. By shifting to percentage deductibles, the insurer effectively amputates the entire bottom tier of the claims distribution curve.
The small, annoying claims.
What they call high-frequency, low-severity attritional claims. And Hanover's CFO explicitly noted on the call that they are seeing a material drop in claim frequency.
And they attribute that directly to these tighter deductibles.
100%. They're forcing the homeowner to retain the everyday maintenance risk while the insurance company acts solely as a catastrophic backstop.
That is brilliant. So if you look at the total package of their personal line strategy,
Yep.
they abandon the riskiest zip codes in the Midwest.
Yep.
They rewrite the contract so the customer pays for the first several $1,000s of any storm damage.
Right.
And then they charge the customer 12% more for that reduced coverage.
And the customers stay.
And they stay. That is exactly how you manufacture an 89% combined ratio.
It is ruthless underwriting discipline. And, that same discipline carried over into their specialty and commercial lines, which provided another massive boost to the quarter.
Oh, right. Specifically, they reported 5.3 points of favorable prior year reserve development in their specialty segment.
Yes, 5.3 points.
Now, favorable reserve development. This is one of those accounting mechanisms that can make or break an insurance earnings call.
It absolutely moves the needle.
So for a listener who isn't an actuary, explain the mechanics of how a company suddenly just finds 5.3 points of profit from previous years. Where does this money come from?
Okay, so when an insurance company writes a commercial or specialty policy, they know claims will be filed eventually, but they don't know exactly when or how much those claims will ultimately cost to settle.
Especially with lawsuits, right?
Exactly. It can take years for a commercial liability lawsuit to wind its way through the court system. So the company's actuaries set aside a massive pool of capital, a reserve, to pay for those future unknown liabilities.
So they just park a bunch of cash.
Yes, it's essentially a very conservative estimate of the worst-case scenario.
It's like setting aside a massive budget for a legal settlement, locking the cash in an escrow account, and just assuming that money is gone.
That's a perfect way to look at it. They take the expense hit on their income statement in the year they actually write the policy.
Okay, so their earnings look a little worse that year.
Right. But as time passes, 2, 3, 4 years down the line, the actual claims come in, the lawsuits are settled, and the actuaries look at the data.
And they realize they over-budgeted.
Exactly. If they realize, hey, we budgeted way too much for 2021 and 2022, the claims were nowhere near as bad as we modeled, they are required to release that excess capital from the reserve.
And because they already took the expense hit years ago.
That released capital flows straight to the bottom line as pure profit in the current quarter.
That is wild.
It is. So recognizing 5.3 points of favorable development in a single quarter for the specialty segment is a massive windfall.
It just shows they were super cautious.
It indicates that their underwriting team was incredibly conservative in their assumptions over the last few years. The catastrophic severity they prepared for simply didn't materialize, and now the shareholders are reaping the rewards of that past prudence.
Which actually brings up a fascinating macro point from the call. When discussing the broader commercial liability market, CEO Jack Roche used a very specific corporate speak phrase.
I know exactly the phrase you mean.
He noted that liability severity trends are maturing.
Right, maturing.
In Wall Street vernacular, that is a direct reference to lawsuits, right?
Yes, he is directly addressing what the industry calls social inflation.
Social inflation. Explain that for us.
Social inflation is the phenomenon where the cost of insurance settlements and jury verdicts rises at a pace significantly higher than overall economic inflation.
Oh, got it. So it's not about the cost of auto parts. It's about the cost of juries.
Exactly. If you look at the commercial auto space or general liability over the last 5 to 7 years, insurers have been absolutely battered by skyrocketing legal costs.
We're talking about nuclear verdicts here.
Oh, absolutely. Nuclear verdicts.
Like you have an accident involving a commercial trucking fleet, and instead of settling for $100,000, a jury awards $15 million.
Exactly. It's out of control. And it is being driven by structural changes in the legal environment.
Like what? What changed?
Well, you have third-party litigation funding, for one.
What is that?
That's where Wall Street hedge funds actually finance plaintiffs' lawsuits in exchange for a cut of the settlement.
Wait, really? Hedge funds are investing in lawsuits.
So yeah, it's a huge business now. Plus, you have aggressive attorney advertising, shifting jury demographics that are increasingly skeptical of large corporations, and, sophisticated plaintiff strategies designed to anchor juries to massive numbers.
Like throwing out $1 billion just to make $50 million sound reasonable.
Exactly. It created an environment of sheer unpredictability for insurance actuaries. I mean, if you don't know how much a lawsuit will cost in 3 years, you can't accurately price the policy today.
So you either underprice it and lose money, or overprice it and lose customers.
Right. So when the CEO of Hanover says the trend is maturing, what is the actual mechanism behind that? Are juries suddenly feeling bad for insurance companies?
Yeah. Did the hedge funds stop funding lawsuits? Why is the curve flattening?
No, it's not that lawsuits are going away or that verdicts are shrinking. What he means is that the rate of acceleration has stabilized.
Okay, the math is becoming predictable again.
Yes. For a few years, the severity trend was a hockey stick. It was doubling exponentially, and actuaries just couldn't catch up. But now, the trend line has become linear. Insurers finally have enough historical data on these nuclear verdicts and litigation funding strategies to accurately model the costs into their pricing.
They figured out the math. The panic phase of social inflation is over, the new baseline is established, and they are simply charging premiums that reflect that new reality.
Precisely. They have priced the social inflation into the product.
Got it.
And to prove that they aren't getting overly optimistic, management actually increased their loss selections, meaning they proactively set aside a bit more in reserves for commercial auto liability and workers' compensation for the current year.
Okay, so they aren't spiking the football just yet.
No, they are keeping that conservative posture intact, which is why the CFO stated they are entering 2026 with the strongest balance sheet in their history.
Honestly, it is a phenomenal operational story. They got a tailwind from the weather, but they compounded it by executing flawlessly on the things they could control.
Geography, deductibles, pricing power, and conservative reserving.
Exactly. But when you are looking at your portfolio, you don't buy a stock for what the company did yesterday.
No, past performance is no guarantee of future results.
Right. You buy it for what they're going to do tomorrow. Let's pivot to management's forward-looking guidance for 2026. What are they promising Wall Street?
The 2026 guidance is essentially a projection of steady, highly profitable growth.
Give me the numbers.
On the top line, they are guiding for mid-single-digit net written premium growth.
Okay, respectable.
But the real focus is on the profitability metrics. They expect their ex-cat combined ratio, which is the combined ratio excluding those volatile natural disaster events.
Right. Ignoring the hurricanes.
Yeah, ignoring the weather. They expect that ex-cat ratio to improve even further, landing somewhere between 88% and 89% for the full year.
Sustaining an 88 to 89% ex-cat combined ratio across an entire year is essentially printing money on the underwriting side.
It really is.
But I want to zero in on how they're treating the weather risk for next year, because this really stood out to me as a deliberate signaling mechanism.
Oh, the CAT load.
Yeah. After a year where they only absorbed 4.5 points of catastrophe losses, they are refusing to lower their official CAT load estimate for 2026.
Right. They're holding it completely steady at 6.5%.
It is a fascinating strategic choice. And the analysts on the call actually pressed management on this point, didn't they?
Oh, they pushed hard. The analysts essentially said, look, you just completely restructured your property exposure. You pulled out of the Midwestern hail alleys. You shifted the homeowners to percentage deductibles.
You did all this hard work to reduce your weather vulnerability.
Exactly. So they asked, why won't you lower the expected catastrophe penalty in your 2026 guidance to reflect that structurally safer portfolio?
It's a completely fair question. I mean, if you put a new roof on your house and install storm shutters, you expect your insurance premium to go down.
You do.
The analysts just want management to show them the permanent earnings benefit of all that structural de-risking.
But management pushed back hard on that.
What was their argument?
Jeff Farber acknowledged that they're absolutely seeing the benefit of the structural changes. That's why the 2025 losses were so low in the first place.
Right.
But he argued that holding the CI load at 6.5% is the only prudent move because of what he called evolving weather patterns.
Evolving weather patterns.
Yes, he specifically pointed to the rising frequency and severity of those convective storms we talked about earlier.
So they're essentially saying, we know we built a stronger ship, but we also know the ocean is getting a lot rougher.
That's a great way to put it.
We aren't going to lower our life raft capacity just because we didn't sink this year.
Exactly. They are explicitly acknowledging the reality of climate volatility.
Which is smart. They are banking the operational wins internally, but keeping a thick conservative buffer in their public guidance.
It's the classic strategy of under-promising and over-delivering.
Because if the 2026 weather is normal, they will easily beat that 6.5% load, and they look like conservative geniuses again.
And if the weather is historically terrible, their earnings are shielded by their own cautious guidance.
Win-win for management. I love the conservatism there. But here is where we need to talk about the metric pivot.
I knew we would get to this.
We have to. Because deep in the weeds of the guidance section, management dropped a structural change to their reporting that immediately made my retail investor alarm bells ring.
You are talking about the decision to drop the expense ratio guidance.
Yes. Hanover announced that moving forward, they will no longer provide specific, standalone expense ratio guidance to Wall Street.
It's a big shift.
It is. They essentially told the analysts, hey, stop looking at our specific operating expenses and just focus on the overall combined ratio.
Which naturally freaks people out.
Of course it does. I don't care what industry you were in. Whenever a management team suddenly says, hey, stop looking at this specific line item expense, my immediate assumption is that they are trying to hide something.
It definitely feels opaque.
It does. Are they masking bloated technology spending? Are the executives paying themselves massive bonuses because they got lucky with the weather and they just don't want the analysts to see the SG&A line items swelling?
It's a valid fear.
Why deliberately reduce transparency?
It is a completely natural reaction. Whenever a metric disappears, the market assumes the worst.
Right.
And an analyst on the call actually confronted them about this directly, trying to get ahead of the exact fears you just laid out. But if we unpack the mechanics of how Hanover actually operates, management's reasoning is highly strategic.
Okay, I listen.
It revolves around where they are deploying their capital right now.
Make the bull case for me. Why should an investor be comfortable with less transparency on expenses?
Well, in the insurance industry, the expense ratio is kind of a catch-all metric.
What's that?
It covers employee salaries, corporate real estate, technology infrastructure, and crucially, the commissions paid to the independent agents who actually sell the policies to the public.
Okay.
Right now, Hanover is in a heavy investment cycle in two specific areas that structurally inflate the expense ratio, but drastically improve the overall business long-term.
All right, what is the first area?
The first area is artificial intelligence and underwriting technology.
AI, of course. Because every company slaps the word AI on their earnings call to get a valuation bump these days.
They do. It's a buzzword.
So what is the actual use case here? Is it real or is it just fluff?
It's very real. They are deploying what they call AI-powered submission triage in their specialty lines, alongside an enhanced underwriting workbench.
What does that actually mean for the business?
To understand why this matters, you have to understand the commercial insurance submission process.
Okay, educate me.
When a broker wants to get a quote for a complex commercial risk, they don't just fill out a neat little web form.
Right.
They send the underwriter a massive unstructured PDF package.
Oh, man.
Yeah, loss runs, safety manuals,
Yeah.
financial statements. It's hundreds of pages of unstructured, messy data.
Sounds like a nightmare to process.
It is. Historically, highly paid underwriters had to spend hours manually reading these PDFs just to figure out if the risk even fits the company's appetite.
Hours of time before even giving a quote. So they're using natural language processing and AI to ingest the PDF, instantly extract the critical data points, and route the most profitable risks straight to the top of the underwriter's inbox.
Exactly. It eliminates the administrative friction.
That's incredibly smart.
It speeds up the, quote, turnaround time, which is absolutely critical because in commercial insurance, the carrier that provides the first accurate quote often wins the business.
Speed wins. I get it.
Yep.
But building, training, and deploying those proprietary AI models, That requires massive upfront capital expenditure.
Huge capital. And that tech spend hits the expense ratio immediately, long before the extra premium revenue materializes to offset it.
Okay, that makes sense. You have to spend the money today to get the efficiency tomorrow.
Exactly.
So what is the second area inflating their expenses?
Variable compensation to top-performing independent agencies.
Okay, explain that.
Hanover relies on a massive network of independent agents to distribute their product. To incentivize those agents to send their safest, most profitable clients to Hanover rather than to a competitor, Hanover's contracts include profit-sharing contingencies.
Profit sharing.
Yes. If an agency writes a massive book of business with Hanover, and those specific clients don't file many claims, Hanover owes that agency a much larger piece of the pie at the end of the year.
Ah, so success breeds expenses.
Bingo. Because 2025 was such an incredibly profitable year with very low claims, the profit-sharing triggers were hit across the board.
They are legally obligated to pay out massive bonuses to their best distribution partners.
Precisely. And management's argument to Wall Street is this: we do not want to be a slave to an arbitrary expense ratio target if it forces us to make bad long-term decisions.
We don't want to cut back on AI investments just to make the current quarter look good.
Exactly. And they certainly don't want to penalize the agents who are driving their most profitable business.
So by shifting the street's focus away from the isolated expense ratio and toward the overall combined ratio, they're just asking for operational flexibility.
They're saying, give us the freedom to spend heavily on technology and agent commissions today, and we promise the total profitability of the enterprise will still hit that elite 88 to 89% target.
So they are essentially saying, judge us on the final score of the game, not on how much money we spent on scouting and equipment.
That's a perfect analogy.
And if you're an investor, you could live with that.
Right.
As long as that overall combined ratio stays in the high 80s, I don't care if they're overpaying for technology.
Yes, it's working.
Because clearly, the technology and the distribution strategy are driving massive underwriting margins. The bottom line profit is what ultimately matters.
Exactly. The proof of the strategy is in the cash flow. And that brings us to the ultimate question for anyone holding this stock.
What is management doing with all this record-breaking cash?
Exactly.
This is where the rubber meets the road for the retail investor, honestly.
It really is.
They printed an 89% combined ratio, they generated massive investment income, and their book value soared.
Yep.
But they are not hoarding this cash on the balance sheet. They are actively and aggressively returning it to shareholders.
Let's look at the share buybacks.
The buybacks are huge.
They repurchased $130 million worth of stock in the third quarter alone.
Then they bought back another $55 million in the fourth quarter.
And then the CFO casually mentioned on the call that they had already repurchased an additional $44 million worth of shares in January of 2026.
Just in January. It is a relentless pace of capital return.
What does that signal to you?
The signaling here is incredibly important. When a management team aggressively buys back its own stock at all-time high book values, it sends a clear message to the market.
They think it's still cheap.
Exactly.
Yeah.
They believe the intrinsic long-term value of the business is still significantly higher than the current trading price. They view their own stock as the best available investment. And they didn't forget the income investors either.
No, they did not.
In December, they raised their quarterly dividend by 5.6%, bringing it to 95 cents per share.
And we should contextualize that dividend hike because that marks their 21st consecutive year of increasing the dividend.
21 years.
In the volatile world of property and casualty insurance, where a single bad hurricane season can wipe out a year's worth of profits, a 2-decade track record of dividend growth is exceptionally rare.
It really underscores the durability of the enterprise.
It proves that Hanover's success isn't just a flash-in-the-pan lucky quarter. They have built a structural compounding machine.
So let's bring it all together for the listener.
Yeah.
When you look at your portfolio, and you were evaluating THG, what you were looking at is a fortress balance sheet.
Absolutely.
You have a management team executing highly disciplined underwriting, walking away from bad geographical risks, forcing customers to retain everyday risk through tighter deductibles, and pushing double-digit price increases without losing their core customer base.
It's impressive.
They are investing heavily in AI to widen their moat, and they're returning massive amounts of capital through buybacks and a growing dividend.
It is the definition of a sleep-at-night holding. They're hitting on all cylinders.
It really is a highly bullish setup. The management team has orchestrated a masterclass in navigating a property and casualty portfolio through a dynamic inflationary environment.
They have built an incredibly resilient financial engine.
But before we close out this deep dive, I want to leave you, the listener, with one final, broader question to ponder before their Q1 update rolls around.
Okay, what is it?
We spent a lot of time today talking about how management fixed the mechanics of the business.
We did.
But we also acknowledged that Hanover's record year was undeniably aided by surprisingly benign weather. I mean, they only took a 5-point hit on catastrophe losses.
Very true.
We all read the news. We all see the data. Global climate patterns are becoming increasingly volatile, and the severe convective storms that Hanover highlighted are becoming more frequent and more destructive.
The 100-year storms are starting to happen every few years. It is the existential threat to the industry.
Exactly. So here's the question for the long-term investor. Is banking on manageable weather a sustainable baseline for any insurance stock going forward?
It's a tough question.
Did Hanover just enjoy a temporary eye in the storm in 2025? Or have their brilliant strategic moves, the percentage deductibles, the retreat from the Midwest, the AI underwriting triage, truly insulated their balance sheet from the physical realities of climate risk?
Can a brilliant actuary actually outmanage the weather over a 10-year horizon?
It is the defining tension of the sector. They've built a beautiful, incredibly efficient ship, but we still don't know exactly how big the waves are going to get in the coming decade.
We really don't.
Keep a close eye on their catastrophe losses in the coming quarters. If the weather turns violent in the spring and Hanover still prints an underwriting profit, you will know this ship is truly unsinkable. Until next time, keep digging into the data.